Okay, welcome everyone, and thank you for joining us today for our program, Not an Afterthought, the importance of SALT considerations in M&A transactions. My name is John Bliley, and I'm a partner in the corporate group here at Williams Mullen, and I'm joined today by my colleague in the tax group, Kyle Wingfield. Thanks for being here today, Kyle.
Good morning, everyone.
Before we kick off our program, I have a few housekeeping items to go over. At any point during the presentation, you may submit questions by using the Q&A button at the bottom of your screen. We'll turn to questions at the end of the presentation. If you're having any audio or technical problems, please use the same Q&A button and our helpful marketing folks will work to get these resolved. Finally, no need to write down everything you see in this deck. You'll receive a copy of the presentation materials by email later today. Okay, let's jump in. Kyle, can you give us a quick overview of what SALT is and why it's important?
Sure. Thanks, John. So SALT is state and local taxes. And specifically, today we're going to be talking primarily about sales and use taxes. SALT, in most deals, historically, the federal tax consequences have kind of driven the deal. But state and local taxes have become more and more important, particularly in the last few years for reasons we'll get into in a few minutes. Sales and use taxes, they typically apply to sales of tangible personal property and certain services. It does not cover intangibles like sales of stock or IP, that kind of thing. Tangible personal property is anything you can see, feel, or touch.
Does that include real estate or not?
No, it does not include any real property. So it just includes inventory, furniture, fixtures and equipment, that kind of thing. Yeah.
Okay, great. Well, thanks for that quick overview so that we sort of understand the context here. So in the context of an M&A transaction, can you give us a quick overview of some of the SALT issues that you're encountering these days?
Sure. The sales and use taxes, primarily we see successor liability issues. That's when buyer might inherit seller's unpaid tax liabilities. And you would expect that in a stock sale where the buyer takes over and begins running the company. You also see it in asset sales too, for primarily it's sales taxes where the purchaser buys substantially all the assets of the business. If they can, they might inherit seller's unpaid sales tax liability. However, we have seen in several states where it's actually broader, and that buyer, unless certain procedures are done, can inherit not only a seller's sales tax liability, but also other taxes like income taxes. And this is on asset deals. And I would say also that this has really become a bigger issue since the Supreme Court's decision in Wayfair in 2018. Previously, you didn't have a taxpayer didn't have nexus for sales tax purposes in a state unless it had a physical presence in the state. Wayfair changed the game a little bit, and that if you have $100,000 or 200 sales in that state, this was South Dakota, that you could have an economic nexus there. And other states since this decision have really kind of jumped on the bandwagon, and so pretty much now every state has got an economic nexus issue. And that you might have sales tax nexus with a state, even though you don't have a physical presence there. A lot of times, the seller may not realize that they have this issue until buyer diligences them on a transaction. And really, where it becomes the rubber hits the road is at the dollar values and the compliance issues. Like if you've got a problem in a handful of states, well, getting it fixed and getting it cleaned up so that buyer can take the assets with clean hands has really become an issue, and we've seen it either delay or in some cases even cancel or kill deals.
So it sounds like folks should consider paying more attention to SALT matters sort of in the diligence phase with buyers and sellers, whereas historically we may have glossed over it, especially if the business touches multiple states. Are there any specific industries or companies that you would see a bigger issue with this?
So you really see it where you've got a seller who sells inventory for sure. And like you said, anytime where you've got a seller that touches multiple states, you potentially have these issues. And it's not just, I know we're talking about sales taxes now, but it can also be for income taxes, and where you've got sellers that have employees that are working in remote places. And we'll stay on topic with sales taxes here, but just it just goes to show that state and local taxes have become a very big deal in transactions.
Okay. Well, now that you got us all nervous about liabilities, what can parties do to mitigate the liabilities that may be posed by salt matters?
Well,
And,
so
and the parties
okay.
can clean up the issue pre-closing, or maybe allocate the risk through the transaction agreement?
Sure. Yeah. Well, so we used to see a lot of deals where the buyers would rely solely on the indemnification provisions in the deal document, which are usually pretty buyer favorable, and and the seller has liability from dollar one. We're not seeing that as much anymore. We're seeing more and more folks rely on bulk sale notice procedures in certain states, where most states will either have a bulk sale notice procedure or a tax clearance certificate. And essentially, if you follow either one of these methods, then the buyer should get out of having any successor liability. The bulk sale notice procedures are really kind of like I know New York has got one, and well, a lot of states do. But you notify the state, say 10 days before the sale takes place, that you're buying all of the seller's assets. And the state will come back and it will let both parties know whether or not there's a problem. If they haven't filed, if they haven't paid all their taxes, and so if it doesn't happen before the closing date, the buyer will be required to escrow a certain dollar amount that gets released once the state gets back to you. And they usually do that pretty quickly. The other option, and like in Virginia, we don't have a bulk sale notice procedure. We just have tax clearance certificates. And in that case, the seller will need to go to the Department of Taxation and essentially get a letter of good standing saying that they've filed all their taxes, filed all their returns and paid all their taxes. And then they present it to the buyer, and that relieves buyer of any kind of successor liability on those issues. And go ahead.
I was going to say, so a quick takeaway here is that maybe we should revisit our standard waiver of bulk sales laws provisions in our asset purchase agreements.
Yeah, I think if you're the buyer, you probably want to revisit it, because with Wayfair and all of the compliance issues that you might have in different states now, it's better to go ahead and get that clean bill of health from the state, so that you're not fighting it on the back end after a deal. And yeah, you might have an indemnification provision, but your seller may be long gone with your money, and you might be stuck, with successor liability and trying to, argue your way out of that. For sure.
Got it.
Yeah. And we'll talk about voluntary disclosure agreements really quickly too. If you're a seller and you've got these sort of issues, one way that we've seen them get cleaned up in a deal is the seller will enter into VDAs with the various states, and typically there's a limited look back period. So the seller, if they haven't filed or paid taxes in a particular state for, let's say, 10 years, the VDA will allow them to go back and only file for the last 3 years. They generally get a penalty waiver. You pay the tax and the interest, and you get a clean bill of health. So that's something that can be done from the seller side. Those take longer. I mean, I've seen those take anywhere from 6 months to a year, depending on the state. Virginia's only got one person that does VDAs. North Carolina, I know, has got a whole team of folks. So they can happen at different speeds in different states.
So would all that be handled by a sort of a post-closing covenant?
Yes. Yeah, absolutely. Yeah. You would do that as a post-closing covenant. And sometimes it's enough for buyer just to see that the seller has filed these VDAs, and that it's, that money's being escrowed, and that might give them enough assurances to continue with the deal, just the mere filing of the VDA request. Yeah.
Okay, well, great. Thanks, Kyle. What about transfer taxes on the deal itself? Are there any exemptions that companies can rely upon to get around the state sales and tax use issues?
Right. So what we've been talking about up until now is historical taxes on the successor liability, sellers' unpaid sales taxes. But now we're in the deal, and we want to see who's going to be paying taxes on the current deal. And often you'll see buyer and seller split taxes. Sometimes you'll see seller take them all, or buyer, depending on the economics of the deal. But generally, the seller has the duty to collect sales taxes unless an exception applies. One of those is a sale for resale certificate. This primarily applies to inventory. So when a seller, well, let me see here. So when a buyer must provide it when it makes wholesale purchases. So say that you're buying TVs from Samsung, and you're going to sell them to consumers. You would give you as the buyer would give Samsung a resale certificate saying, "Hey, don't collect taxes because I'm going to go ahead and sell them to the end consumer." And then you would collect sales taxes from the consumer. If you're the seller, and if you have an inventory, then you would collect sales tax clearance or resale certificates from your buyer if they're going to resell it. And so if you're the seller, you have a duty to collect sales tax unless you get the resale certificate from your purchaser. These are generally not filed with the Department of Revenue. The seller will keep them in their file in case they get audited. They can produce them to the Department of Tax, saying, hey, I got a resale certificate from my purchaser. It was properly filled out, and I didn't know what they were going to do with it. So I have some assurances there. We see this come up, and this also it's an issue in the current deal because you obviously want to minimize your taxes. But just to go back a page or two, we do see compliance issues where folks have not been collecting these sales certificates, these resale certificates, while they've been operating from folks that they've been selling to. And so that can also become an issue on a successor liability issue. And there are various ways to try to solve that. You can go back to your purchasers and try to get resale certificates from them at that time. That can obviously be a little bit cumbersome when you're under the pressure of getting your deal done. Other options for resolving this are to escrow, pick a number and escrow it until the statute of limitations runs. If you're the seller and you've been filing sales tax returns, then there's typically a 3 or 4 year statute of limitations on it. And so if you can hold out until that happens, then that's also a strategy. Since we're running a little bit close on time here, I want to also talk about the occasional sales. So resale certificates will take care of inventory, but what about everything else, your furniture, fixtures, and equipment? Most states have what's called an occasional sale exception, and that's when you sell all or substantially all of your business assets that no sales tax will apply. It's an exemption. Some states also require that that you have 3 or fewer sales over a calendar period, and that you're not required to register for sales tax in that jurisdiction for the type of thing that you're selling. In some states like Maryland and New York, you don't have an exception, an occasional sale exception at all, or it's very limited to not really be any kind of useful in a transactional sense. It might only apply to household goods or to anything less than $1,000. Again, it's not, you don't file the occasional sale with the Department of Revenue. It's just a reporting position. And what I like to do for inventory is if I'm advising a client on buying a business, I will tell them to use the sale for resale certificate on all their inventory, and then use the occasional sale exception for everything else. And then, I've papered the inventory, the other item, the FF&E and whatnot. I've got the occasional sale exception. And then I also use the occasional sale exception as a backup reporting position for any kind of inventory. And there are various other strategies when you run into this that you can use. Say that you're not selling all or substantially all the assets. You could drop the assets that you want to sell into a special purpose entity, and then you're selling all or substantially all the assets of that SPE. And one other quick thing, because we have run out of time, is that this typically does not apply to any kind of rolling stock in cars, motor vehicles. Those have special rules, particularly in Virginia. So I think that's we've run out of time, unfortunately, but
Yes, indeed. Kyle, you packed a lot into a short period of time. Thanks for all that.
Sure.
It looks like we're about out of time. So if you have any questions, we'll reach out directly. And thank you all for attending today's program and have a great day.